Hello viewers, welcome to Market Guru with me, Piyush Jain. Now markets are showing some signs of selling or nervousness after the SEBI circular on the shell companies. Now is it all because of shell companies or there are some real reasons for which the investors should actually get cautious? Let's ask this question to our Market Guru today, Chakri Lokapriya, CIO and Managing Director at TCG Advisory Services. Mr. Chakri, welcome to the show.
Now, morning, Piyush.
Good morning. So I think the first question here is, the markets right now are interestingly poised around the levels of 10,000. Now the first question here is, are we really sensing a deep correction, 9,500, 9,000, or is it like a moment of pause and perhaps the move to 10,500, 11,000 is still alive?
I think it's a moment of pause. Yes, this SEBI circular on the shell companies has created a kind of a fear that which companies will follow next, and also fears of NPAs as a result of these companies going into problems and not servicing their debt obligations. But NPAs is a well-known problem in India, and for the last few years NPAs have reached 10-12%, and now we are cleaning up the books. The government is doing what it can. We are going into the festive season. So I think because of past demonetization as well as GST, the pent-up demand will be reflected as we go into Diwali.
So then, what do you think basically, why are markets actually really getting jittery here? Is it about that there was a time large caps actually were seeing good valuations, perhaps there was less room, like the investors were looking for which pockets are still available actually at a reasonable valuations, and that markets just needed basically a reason to slightly sell off, slightly book profits and get lightened up? Or you think there's some factor which right now is slightly unknown, and is there something which you are worried about, which you think that investors should really get cautioned about?
Well, two things happened in the month of July, which was partly technical and partly sector rotation. Because of the P-notes winding up banning SEBI led to a short covering in IT as a sector, and thereafter you had a run-up in banking. And Nifty was up 5.8% in one single month. And therefore, when you have such a strong run-up, individual stocks went up far more than that. And you are seeing, therefore, some amount of profit-taking in the current environment. So that's all I would read into it.
Right. So again, then if you look at the global cues, and we basically hear almost every third day that either US markets are making new highs, or the European markets, like someday the German market, another day like could be the UK markets, but those are actually making new highs. And it's not only equity markets. Look at the bonds, they are doing great. Look at the currencies, or even actually you look at the commodities. Again, basically we were seeing copper basically testing new 32-month high. Zinc actually again going at 6-month high, already was actually higher levels. Aluminum again, so very broad base metal rally. So it's like very unique time where across all asset classes are doing good. So like, what do you think, like, is it like too good to be true, or is there a recovery in the international trade which perhaps, or very high liquidity which could sustain for many months?
We are seeing a synchronized earnings recovery across the globe. If you look at the US, earnings for this quarter and for this year is expected to be up 10%, which is a very strong number. Europe is showing signs of recovery. Its earnings also are accelerating. And so on back of that, and you just mentioned about aluminum metals, Novelis saw very strong numbers on uptick in automobile demand in the Western developed world. So this is actually a real thing, and more than liquidity, you're seeing earnings growth. And it benefits a number of sectors, even from an Indian context. And if you look at, for example, export-related sectors, textile is one important area. Companies such as Trident, low capacity utilization, strong market share. They make bed linen and terry towel kind of products. US is going into a very strong festive period itself, back to school and thereafter Christmas. And so companies like that will benefit from an Indian context.
So right, in that context, do you think that perhaps whatever is happening on the currency side, there has been some appreciation over the last 2 quarters on the rupee front also versus the dollar? And broadly, if I look in terms of the currency trends versus euro, again, the longs in the euro itself are at a 6-year high. We are now actually looking at euro at 1.18. Even if you look at yen, there has been some strengthening in yen. Pound basically has been recovering. So it's not a singular rupee trend. Broadly, dollar is actually weakening. So in that context, where you are seeing really the 6 months seasonally should be quite good for the stock like Trident or other export stocks. Is there a concern some sort of around currency, or do you think volume growth actually should satisfy everything?
Volume growth should more than what you call take care of the currency appreciation, because normally contracts also take into account currency appreciation, which is passed on or passed back depending on how the currency moves. So more important is the underlying demand trends, which are strengthening. We just spoke about textiles. Another sector is specialty chemicals. Now today you had Make Money Organics, which reported very strong numbers. It has more than 50% of its revenue coming from exports. So another company like Akshar Chem, which is in the same space as Make Money, should do well by the same logic. And mind you, we are coming out of a season where these companies are trading at low valuations, 7-8 times PE, and on coupled of an economic recovery, you should see significant re-rating of their multiples.
That's a very interesting trend which you're saying. Now, I'm just trying to link here. Singapore GRMs around $7.4 must be, I think, the strongest in the last 3 quarters. So, which means that the refining actually margins are looking quite good. Usually, petrochemicals, they follow with a 1-quarter lag if the refining is doing good. So, that could imply that chemical prices perhaps could be more stronger 1 quarter later. So, with that trend in mind, what's your understanding about broadly how are the chemical prices could be positioned, both in terms of your view on the China capacity cuts, but also in terms of the way prices are moving, are actually they sustainable?
Yeah, 2 or 3 things are happening, as you rightly pointed out. One is China is cutting down capacity. 2, you're seeing an recovery of demand in US and Europe. 3, these companies in India have expanded capacities, like Deepak Nitrite has expanded capacity in the recent past, and Make Money Organics has just completed a capacity expansion. And so there's no more capex. And as you know, like you said, refining margins improve, chemical margins will also improve. So you have a stronger demand coupled with stronger, translating into higher prices, and low capacity utilizations will allow the profitability of these companies to grow very strong.
But do you have any concerns around the pollution norms? We actually saw what was happening in China. Is there any sort of risk that could also actually percolate into sort of stricter pollution norms for these companies? Maybe not 1-2 quarters, but maybe like in the next 1 or 3 years. Is there some sort of risk there, or you think these companies, they already have quite strict norms implemented within their own machinery, their own operating norms?
You know, that's a very good question. In fact, India has also, the government has been doing a good job in strengthening these various pollution norms. Now, if you look at a company like IG Petrochemicals, and so those guys, they're doing a brownfield expansion, and they're meeting the higher levels of pollution control norms. And so this translates into that it's a sustainable growth. So you're taking care of environment, you're meeting all the effluent treatment, etc., and you're going into an generally an earnings recovery period. So environmental laws, in a sense, will not hold back because these companies are meeting the new standards.
So at present, if these stocks are trading actually at single-digit valuations, why do you think if there is such a high margin trend, the refining is doing good, chemical prices are actually quite kind enough, it's a known fact that Chinese capacity is actually getting reduced, partly because of their own pollution norms. I think it's roughly last 5 or 6 quarter phenomena. Why are these stocks not being traded in double-digit P multiples? Why is the market still giving them very high discount compared to much larger companies?
I think two reasons. One is today's mid cap is tomorrow's large cap. It takes time for a company to grow. And so they're having those mid cap discounts to their multiple. And as they demonstrate their earnings capability, which increasingly they are, you will have a gradual run-up increase in multiples. But these are investments, so which we think will do well over the next 1 or 2 years and not trades per se.
Right, so which means stocks like, as you're pointing out, Akshar Chemicals, again, these actually are positioned quite nicely, even IG Petrochemicals. So perhaps these make money organics. These are the companies, these are themes actually where the investors actually could really bet on, or could really actually just watch them carefully. And as even the charts are telling you that stocks have been rank outperformers. So now, let me ask you now on another theme, the jewelry theme. Gold prices, they have been doing quite good. In terms of jewelry stocks, those actually are also have been outperforming. Stocks like Titan, its foray into US markets are recent, which they're trying through Amazon. And again, they're actually foray into more creation of new brands. Is that something which is telling you that perhaps more value creation could be in the offering for investors? And is that entire pocket which is looking attractive for the investors?
Indeed, because you have a couple with both domestic and foreign demand. Now, the foreign demand is items, small jewelry items versus the large chunky ones, where the smaller ones, which what Titan makes, and other firms in that space like Tara Jewels, Gitanjali, etc., are seeing a becoming demand because the distribution channels internationally have expanded, making it easier to reach. And domestically, now you have 3 festivals in a row in India, which are all bunched up from end of August to middle of October, and after that is the marriage season. So, and given the last 1 year, you've had GST uncertainty, demonetization uncertainty. There's a bunched up of demand which is postponed to this year, and therefore jewelry stocks and as well as consumption stocks, including autos, auto ancillaries, will do well.
Right. So again, within the jewelry, is there anything basically which you think is more durable, more sustainable? Because within that space also, we have seen Rajesh Exports actually, because of the European refinery which it acquired, has actually grown in terms of market caps. Titan itself has been actually growing consistently over the many years. And there are some small actually jewelry stocks which offer some sort of different valuation metric here. So what sort of theme the investors should target actually here?
Titan is an excellent example because it has now become a lifestyle company, including jewelry. You have watches and other accessories. And these are all fast-growing items, still don't make money for the company. Still, it's a jewelry business which earns profits for the company. But that's okay because they're increasing the channels of touch points. And these are all low-ticket, high volume items. And therefore, the demand is expanding from Tier 1 to Tier 4 cities. And even Titan is expanding its presence in the smaller towns. Against this backdrop, so you will see a sustainable demand. Even though the valuations may appear high, the growth is higher, so they'll sustain.
Okay, now let me ask you on a sector which you just touched upon, the auto ancillary pack. Auto index has been a rank outperformer, but auto ancillaries have outperformed even the equipment makers. So and different categories. So within the auto ancillaries, is it something which you're focusing like on niche pockets, like some company which would be catering to electric vehicles or any sort of commercial vehicles or two-wheelers? Like what sort of theme you'd be playing on?
So auto ancillaries is quite a big segment, right from tire manufacturers, whether it is Apollo Tires, JK Tires. Now these names, for instance, the commercial segment has been weak. Now we expect the economy to improve, because if you look at various parameters, still the economy is not doing that great. Coal production is negative 6%, industrial production is largely flat, 0% year over year growth.
Absolutely. IP data is also not that actually good.
As not at all. So against this backdrop, commercial vehicle sales have been low. So any marginal pickup translates big time into the bottom line for commercial vehicle manufacturers on one hand, like Ashok Leyland's of the world, and then suppliers to them, the tire companies like JK Tire, Apollo Tire, and they're also benefiting from a correction of rubber prices. And so when a pickup in demand as well as a reduction in raw material costs translates into higher profit margins. On the other hand, you have other ancillaries like, if you look at GST, post-GST, you see all the confusion about high-priced cars versus low-priced cars, different tax rates. So two-wheelers are the beneficiary because they will have a lower tax rate. So suppliers to two-wheelers industries like FIAM Industries, Lumax Industries, they make all the lighting equipment and LED equipment for the two-wheelers.
And then we should continue even in the electric vehicles also.
Indeed.
So has a sustainable trend.
Has a sustainable trend. And they've again not done too well in the sense of the valuations are still very appealing. So there's still enough space to go by.
But from that perspective, what do you think in terms of, you were already highlighting on the valuations, but in terms of the comparative analysis, where actually is there a real value right now? If you're looking at the tire space, the anti-dumping duty, the recommendation has been sent to the finance ministry. Is that something which also actually excites you? Because if that is being actually approved by the finance ministry, in all likelihood the market is actually expecting that. Is that perhaps the tire companies could start getting market share from the imported tire, which right now was somewhere around 15-20%. So do you think that even that space is also looking interesting? Indeed,
and it's looking good for 2 or 3 reasons. One is, of course, whenever the import ban comes, that will be an additional catalyst. Leading into GST, you had that channel destocking, pricing uncertainty, and also the rubber prices were going up a few months ago. Now the opposites are happening. Rubber prices are coming down. All this demand which did not happen, now when you're going into Diwali, Navratri and the other festivals that are coming in India, you'll see a pickup in sales. And then combined with, if this import duty does come along, you will see an improvement in the profitability of these companies. And given that they're trading at 7-8 times PE, there's still sufficient room for the valuations to improve. So now on that perspective, JK Tyre has more than 20% market share in the truck and bus radial tire space, but so actually Apollo Tyre also has. So if I'm trying to compare with something which you'd be liking like JK Tyre or that theme as such, Apollo Tyre is also another space. So like why should be investors preferring JK Tyres, or is it like all the companies which would be having higher market share exposure to tire space actually would be offering equal opportunity? JK Tyre has a higher exposure to commercial vehicle sales versus Apollo, but that whole space is looking good, including Apollo is looking good. And so when you have a higher exposure to a sector which has not been doing well and you expect a recovery in the economy, the first thing that happens in an economic recovery is a pickup in commercial vehicle sales. And so that is one theme that we are anticipating will play out in the coming months. Yeah, and maybe GST tailwinds also if the impact is that successful. Indeed. Let's also talk about something which is quite relevant right now. August month, middle of the monsoon season, and we are actually talking about some sort of good monsoon so far, like almost in line with what was being forecasted. Is there any theme or any stock ideas related, stock themes rather related to the monsoon which you think have not played out fully and perhaps investors can still cash on them? See, monsoon, one is good monsoons this year, and also you have a last 2 years of election, waiting for the election, so which means you'll see a huge amount of government thrust into this particular area. So all companies which supply irrigation equipment like Jain Irrigation, Finalex, a smaller cousin like Kisan Moldings. So it's like pipes, drip irrigation. Pipes, drip irrigation, which will see a huge amount of, now you see rally for rivers, all kinds of momentum, positive news flow is building on this sector. And also the contracts being awarded by Maharashtra government, Gujarat government in this sector, these are not yet real contracts, they're going to be awarded. And so that's why we see a strong revenue momentum. And also if you look at Finmera, which is an international company, a private equity company which recently acquired a stake in an irrigation company which also supplies equipment in India, 15% market share, at twice the valuation, at like 14-15 times EV EBITDA. And these companies trade at probably 8-9 times. So we're not suggesting that it will go to 14, but clearly it shows that there's value in the sector and they can trade far higher than here. But do you think there is enough clarity in terms of the agriculture policy or even durability of historical track record and growth which eventually could push these stocks towards much higher multiples? Because we have seen like a lot of policy flip-flops happen every like 2 or 3 years, and then while the growth signs they become visible, but then again it starts fading away. Is this this time it's different? Yeah, policy flip-flops happen in whether cigarette smoking is good for you or bad for you, or whether luxury cars, higher tax or lower tax. The government usually doesn't mess around with farmers. So there is fairly consistent supporting the farming community.
So volume growth should be
So
more
volume
durable.
growth must be very durable and sustainable. And also if you look at the secular characteristics, the penetration, irrigation penetration is extremely low in India compared to other countries. You take Israel or even any of the several countries, Mexico or Brazil for that matter. So against this backdrop, it's a huge secular theme.
Right. And then let me ask you now around something which is really buzzing since last few sessions is metals. Metal stocks, those are some of the themes which perhaps are not the best light themes for you, but still, because the market is really actually rating them quite highly, commodity prices, as we were talking slightly earlier, they all actually have been moving higher. So stocks like Vedanta, Hindalco, even the state-owned companies like NMDC, Hindustan Copper, they all actually have been making new highs. So what's your own opinion right now? Are these stocks over-owned, still under-owned, and is the rally for real? Because metal prices are like moving so fast that perhaps as if like the entire industrial trade is actually booming.
We like metals at this point in time because it's driven by fundamental factors. You've seen that steel volumes have moved up 6%. Yesterday, Novelis has shown a strong improvement in aluminum demand because of rising demand for automobiles as well as fast-moving consumer goods. A Pepsi can or a Coke can is made out of aluminum. And so against this backdrop, these companies have a lot of capacity. So there's a huge amount of uptick in sales that can happen without further capacity expansion, and therefore profitability will improve. And second, so both you have the US and Europe very strong demand, India slowly recovering. So I think it is for real and they can go much higher from the current levels.
So do you believe that the improvement, whatever we are seeing in terms of realization or even the volume growth, that is for real and that can last? Because just if the price starts falling by 10%, the volume growth estimates they can just go awry. So do you think it's quite real?
Yes, you have had many years of downturn in the metal sector. So you'll see very sharp year-over-year growth numbers, but still the way off the highs. And given, so we think it's a very sustainable trend, and both steel and aluminum will see recovery in the next year or two.
Right. So we have talked about a lot of stocks. Let me actually give out all the names here. Trident, Make Money Organics, Jain Irrigation, Kisan Moldings, Finolex Industries, Fame Industries again, Lumax, JK Tire. All these we have talked like as a theme basically, which perhaps could be offering good value to the investors. Now, if I just take a seat back here and if I just think about the first quarter results, what's your overall take on the first quarter results? Have they been slightly above estimates? Because I remember you were highlighting that US earnings actually were looking quite good. In terms of the Indian earnings, do you think similar sort of conclusion can be made with the way for the first quarter has panned out?
I think that's a good question. If some of the companies you mentioned, for example, Trident or Akshay, wherever there is a good export component, those companies have done well. And Indian component, because of GST uncertainty, they've been all over the place. But that's even if you look at paint companies for that matter, Berger did well, Asian Paints did bad in terms of earnings results. So smaller companies down the chain, AkzoNobel, etc., it doesn't matter whether they do well or bad for this quarter. Because there is a GST uncertainty, there will be an uptick in the next quarter demand. And as far as the overall earnings is concerned, I think you have about 6 to 8% for this quarter earnings growth, which is a very good number, given the uncertainty that you went into in this quarter. Analysts were not sure how badly GST will hit, and so it's turned out to be that way a positive surprise on the whole.
So, right, I think that's what he's saying. The first quarter has been a positive surprise. Global earnings, especially US, that is actually looking good. So, overall global cues perhaps could be looking sustainable slightly in terms of momentum also. Commodities also, as you pointed out, that perhaps the prices could also be actually sustaining around the current levels. So, which implies is what actually we have is the trend is looking quite stable right now. And also, we have a lot of themes actually which could be playing out over the next 2 and 3 quarters. And just remember, irrigation, specialty chemicals, textiles which have an export exposure, the auto ancillary names which we talked about, all those actually could be offering some value, as what actually Mr. Chakri Lokapriya is saying. So watch out for all those stocks. Those perhaps could be or should be on your radar. So with that, that's a wrap on our edition. Thanks for watching us from the entire team here.